This earnings season is a good reminder that the market does not simply reward good numbers, it rewards numbers that are better than expected. That's why Shopify can report GMV up a whopping 35%, revenue up 34%, and free cash flow up 31%, yet the stock still falls close to 15%. And at the same time, Alphabet puts up what looks like monster quarter with revenue up 22%, operating income up 30%, cloud revenue up 63%. And suddenly, the old narrative that Google was going to be disrupted by AI looks a lot less obvious and well into the rearview mirror. The common thread today is expectations. Some companies are showing strong results, but valuation already demands a lot. Some companies have softer headline numbers, but the underlying business may be improving. And in a few cases, AI, energy, and infrastructure spending are showing up in places investors may not have expected.
Yeah, I think that's a good way to frame it because this is a pretty wide mix. So we have Alphabet showing that AI may be more of a tailwind than a threat. Shopify is showing that strong growth can still disappoint when the valuations are so high. CP Rail had softer headline quarter, but the metrics underneath of it looked a lot better. Toromont is kind of showing how AI demand can pop up in very unexpected industrial type businesses. Suncor benefiting from higher oil prices, record production, and then we have an interesting segment on GameStop trying to buy eBay. It might be one of the strangest acquisition stories we've seen in quite a while.
Exactly. And I think the main lesson for investors is that the headline tells you what happened. The stock reaction tells you what investors thought was supposed to happen. And that is where people often get tripped up. Shopify is the obvious example here. The quarter looked strong on the surface. GMV hit 100 billion. Revenue was 3 billion. Monthly recurring revenue increased 16%. Free cash flow was up 31%. But the stock was down sharply because guidance pointed to revenue growth slowing in the high 20s. Investors are still trying to figure out whether AI is a headwind or tailwind for the business, and the stock was trading at more than 60 times forward earnings and free cash flow. That is a very demanding setup.
And I think it's very different from saying that Shopify is all of a sudden a bad business. It's more so that when expectations are high, strong growth might not be enough. Investors need strong growth, durable margins, confidence in the AI story, especially with a company like Shopify. And there was a valuation there that kind of left little room for error.
Alphabet is almost the opposite example. So this is the company's 11th straight quarter of double-digit growth. Revenue was up 22%. Operating income grew 30%. Margins expanded. Cloud revenue grew 63%. Cloud operating income tripled. And management said cloud revenue would have been higher if they had enough compute capacity. And that last point really matters. For all the debate about AI spending, Alphabet is giving investors evidence that the demand is real. This does not look like a demand problem. It really looks like a supply problem.
Yeah, and on the Canadian side, these themes are showing up in many different ways, I would say. So Toromont is a great example because most would probably not think of Toromont as an AI play, more so a equipment play, but AVL, which is a company they acquired, a very tiny company, which builds steel housings for backup generators, switchgear, steel housings for switchgear, things like that, which are very popular with data centers. Saw revenue go from 22 million in the first quarter last year to 129 million in the first quarter this year. That segment actually made up 17% of Toromont's earnings, whereas previously it made up pretty much nothing. So AI is not just software and chips, it's also power systems, electrical infrastructure, backup generation, cooling, equipment, industrial capacity, all that stuff.
CP Rail is another example where the headline and the underlying business tell slightly different stories. Revenue was down 2%, earnings missed estimates, and the operating ratio got a bit worse, but average train weight was up, train length was up, dwell time dropped, and fuel efficiency improved. Those are not flashy numbers, but they matter. If volume recovers, those operating improvements can start showing up more clearly in earnings.
Yeah, and then with Suncor, you get a much more direct macro story. So higher oil prices are definitely starting to show up in the numbers. Revenue was up 18% year over year and 20% sequentially from last quarter, even though Q1 only included 1 month of higher oil prices from the conflict in the Middle East. Net income was up 24% year over year and 42% quarter over quarter. So they had record first quarter upstream production of 875,000 barrels per day and record refining throughput.
Yeah, and for listeners less familiar with energy, upstream just means the oil and gas produced before refining, basically what comes out of the ground before it gets turned into usable products. The other important part is capital returns. Suncor increased its buyback guidance to 4 billion, up from 2 billion just 5 weeks earlier at Investor Day. That's a big change in a short period of time, and it shows how quickly higher oil prices can flow through to cash flow and returns to shareholder.
Yeah, and then we have the GameStop and eBay situation. So GameStop, roughly a $10 billion company, is trying to buy eBay for around $56 billion. So it has cash. It reportedly has a financing letter for TD for around 20 billion, and I think they have around 9 billion in cash. But there is a major funding gap here, which we're going to talk about eventually.
Yeah, when Ryan Cohen was pressed on how the math worked, Ryan Cohen, the current CEO of GameStop, the answer was essentially 50% cash, 50% stock, and then we'll see what happens. And that's not the kind of clarity investors usually want when a smaller company is trying to buy a much larger one. So that is the framework for today. Do not just ask whether the quarter was good or bad. Ask what was already priced in. Ask whether the business is getting stronger. Ask whether AI, energy, infrastructure demand is actually showing up in the numbers, and ask whether the valuation gives investors any margin for error.
Yeah, that's what we're going to do now. We'll go story by story, starting with the GameStop situation, then moving into Alphabet, Shopify, CP Rail, Toromont, and Suncor.